Hello, everybody, and welcome to the VRIC Media Channel. Our flagship event, the Vancouver Resource Investment Conference, is coming up January 19th and 20th at the Vancouver Convention Center. We have an incredible lineup of guest speakers, keynote speakers, company CEOs, and more. And the best part of all, it is completely free to attend. So get your tickets by clicking the link in the description below. But of course, we are bringing the VRIC to you each and every week with our series of expert online panels. And I'm very excited for the one we have lined up for you today. It's Jack Gamble, host and producer of Nobody Special Finance, and Melody Wright, author of the M3 Melody Substack. We're going to be talking about real estate, which I'm stoked to dive into because it's a topic I'd like to be educated on. It's great to have both of you on the show.
Jesse, thank you so much for having us on. Melody, always a pleasure to see you as well. Thank you, guys.
Yes, thank you so much, Jesse. Looking forward to this.
Well, I want to start with a broad question, and that is, what are the main themes and trends you're currently watching when it comes to the real estate market? And you can stick to the American real estate market. If we want to look out on a global basis, feel free as well. But what are the main themes and trends that you think more people should be paying attention to? Jack, I'll start with you.
So the two big trends I think are the constants in real estate. You've got employment and on a much higher level, just overall affordability. We're seeing slow but steady rises in the unemployment rate. Chair Powell just earlier this week made several references to some continued unwelcome softening in the labor market. That was some unusual, a little dooming language there from Chair Powell during that press conference. He mentioned that the labor market is now less tight than we were pre-pandemic. So not a good sign for the employment statistics there. We're also seeing things hidden within the employment numbers that I think are somewhat masking just how miserable conditions are. Things like loss of full-time jobs being offset by gains in part-time jobs. So that's not good for the housing market because that typically comes with lower pay, less benefits. Also, things like a rise of multiple job holders. That's a sign of desperation among homeowners. I lost my full-time job. I got to get two lousy part-time jobs to still make the mortgage payment. So that pain is cumulative in the housing market. It's not like a one-off. It gets worse and worse as people eat into their savings month after month. And we're yet to really see that show up in the housing market. And then the other big one, in my opinion, is affordability. And Melody's better in touch with the statistics than I am on the housing numbers, so she could probably correct these numbers for me. But, just doing some looking before we went live here, the National Association of Home Builders earlier this year had said that the median home now costs, for a single family home, the median home costs 38% of the median take home pay in the country. And that was a first quarter 24 number. So it may have gotten a little bit worse. Now, I mean, historically, all the traditional wisdom is never go above 30% of your take home for housing costs. And right now, median, where most people lie, is significantly above that level. So affordability is really stressing the housing market. And on top of that, the problems in the employment market will only add to those affordability problems.
And Melody, I'd love to hear your thoughts. I know you specialize quite a bit in the real estate market. You've got a fantastic account on X where you discuss it in depth, so I definitely recommend people follow you there. But give us your thoughts at the moment on the main themes and trends you're watching when it comes to the real estate market.
Yeah, there's just so much going on, Jesse. And I think so few people really understand how complicated the housing market is in the United States and just how much government intervention there is. 85% of outstanding mortgages are sponsored by one of the government agencies, be it a GSE or government sponsored enterprise. That's Fannie Mae, Freddie Mac, or an agency like Ginnie Mae, who those are fully insured. There's a lot of problems with that, though. So, I think I want to talk a little bit about history, and Jack's absolutely right on affordability. We'll get to that. But history, post the great financial crisis, essentially what happened is the banks said, we're not doing mortgage anymore because Basel III came out with all of these stringent capital requirements around those mortgages. Not to mention, they really got burned. The banks did, as well as my company, partnering with those government agencies because they will do things like delay claims. They will also nickel and dime you. And so this is important to what I'm getting to. But essentially, and this is the mortgage market that is backed by mortgage-backed securities. This is what makes the U.S. housing market work. And what happened after the GFC is that all of that went to these non-bank entities, and the banks were happy to be like, okay, go away. But they don't have deposits, so they can't really lend based on, their credit. They basically lend based on the full faith and credit of the United States government, kind of. So they immediately sell those loans off to one of those agencies, and they use these large revolving credit facilities to be able to do that. And so the fact there's a lot about that. Understanding that without that government intervention, we wouldn't have a housing market. So that's one thing I just want everyone to kind of understand. So what happened, to Jack's point, is that essentially, conventional wisdom, everyone would tell you 28%, 30% is what you should put toward housing. Okay. So unfortunately, what our government did, or those in charge. So you had this thing called the Consumer Financial Protection Bureau that came out with all of these rules through Dodd-Frank after the GFC. So we could never do risky lending again. That was the battle cry. No risky lending, no risky lending. Well, guess what happened? Instead of it was the private markets, actually the government market started loosening requirements. And so in reality, all of that legislation after Dodd-Frank, the teeth were pulled out of it in 2021. And so what you've basically had is you've had the government step in to that subprime market and our non-prime market. And so what we're seeing right now is that non-prime, if you take the government portion, and that's the big Ginnie Mae, plus the privates, 25% of the market is 9% delinquent right now. But if you look on any schedule out there, be it from Fred, who only tracks delinquencies at the big commercial banks, or you use Black Knight, who only has 30% of all mortgages, you get a very skewed picture of delinquency right now because of those. And then something that the governments do, and I'll be done in just a second because I just want to lay this foundation. They also do these things called non-performing loan sales, and they've been doing them since 2004. And what this does is they buy up any of these delinquent loans and they sell them off to private hedge funds, believe it. Okay. So then delinquency, if you go look at a Ginnie Mae loan performance report or Fannie Mae Freddie Mac loan performance report, delinquency looks great. Well, where do those loans go that are delinquent? Well, they go off into a big black hole that we don't know. So my point in all of this is I'm watching all of this under the covers because so many people misunderstand what happened in the last crisis. They believe it was subprime. Well, subprime was really non-prime, non-traditional products for investors. Yeah, there were some arms, which that's, the issue kind of in Canada. We can talk about that. There were some arms that were done, but usually those were for high credit quality, believe it or not, like an 800 credit score. They just, essentially didn't have they didn't prove income. But so you're seeing a lot of that happening as well now in the private markets. And so I think what's happened is you had a lot of people think that that everything was done a whole much better and the credit quality picture is a lot better than it is right now. And I'm watching that deteriorate. And what's important is that, essentially non-prime didn't take the housing market down. The prime borrowers did. That was the big share of the foreclosures. And essentially that didn't peak until 2010. And we are just now starting to see delinquency increase. And I'm sorry that was such a long answer, but I kind of want to give that, I'm watching those things that are happening underneath because it's really important on top of these things we talk about like rates and aggregate affordability. I believe that we're already in a lot more trouble than most people realize.
Don't worry about long answers. We love those on this show. The more detail you can go into, the better. So it sounds like a pretty negative outlook from both of you. With that in mind, are there any areas of the real estate market right now that you see as an opportunity from an investment perspective? Because people hearing what both of you have said would probably think, well, I'm staying out of the real estate market then. But is there anywhere that is not affected by all of these negative trends you're seeing, or that you think could now be undervalued because of these negative trends, where there could be opportunity out there? Jack, what are your thoughts?
So this was a hard one. I kind of struggled with this one because you may have noticed I'm pretty bearish on real estate with my first answer, and I agree with everything Melody just said. So I'm avoiding anything pertaining to housing like the plague right now. That being said, real estate isn't just housing. One area I find interesting is energy. In particular, with the real estate spin, things like not so much what's on the land, but what's under the land. Things like oil, gas, and mineral rights. We've got a new Treasury Secretary coming in, Scott Bessent. I don't know how to pronounce his name. But part of his plan involves big increases in domestic energy production. And on top of that, we've got rising electricity prices in this country. In certain regions, they've doubled, like in Northern Virginia. As part of this big build out in artificial intelligence, which I've talked a lot about on my channel, we've built these data centers full of thousands, in some cases, hundreds of thousands of these NVIDIA GPUs. Well, every one of these GPUs uses as much power as a household of 4 people. So a data center with 100,000 GPUs will use as much power as a city of 400,000 people. And so retail electric rates in Northern Virginia have doubled in the last year, which means we need a lot more electric. And what's going on, we're spinning these stories like there's companies out there like this nuclear startup Oklo, which in my opinion is just a big let's sell stock to suckers kind of company. They're talking about nuclear. I spent 15 years working in nuclear power. I can tell you nuclear energy will not arrive in time for these data centers. It moves so slow, that industry. And that's on purpose. Nukes are notoriously careful. So even though all the talking points about nuclear and even pipe dreams about fusion are being sold out there, what's really going to power these data centers is going to be natural gas. We're going to have to produce a lot more natural gas domestically. We've got a resource-friendly administration coming into power here. So things like obstacles to pipelines, fracking bans, I think those things are largely behind us, and we're going to start moving in the other direction. So oil, gas, and mineral rights is an interesting twist on real estate where there may be some opportunity, even though real estate as a whole is largely overvalued right now. Now, I would throw one little caveat in there. A question is the Saudis. And what did the Saudis do? The last time the United States was gaining market share in the energy space in the early 2010s, the Saudis threw a fit and they flooded the market with oil supply. It crashed oil prices. It dragged down natural gas with it. And that was more painful for the Saudis than for us, in my opinion. And it's questionable whether the Saudis would want to do that again, but they could. And if the Saudis decide to do that, if they pull back and they open up the valves, decide to flood the market with supply, that could put a real damper on domestic energy production here in the States.
Interesting, Melody. And any thoughts you have on any areas you're potentially seeing opportunity right now?
Well, I just want to congratulate Jack on coming up with an opportunity because I'm not going to have one. Yeah. No, listen, there's always opportunity if you know where to look, right? And unfortunately, what happened during the COVID boom, the housing boom, was speculative mania, and everyone went wild wanting to buy a short-term rental. First, they started with long-term rental because that was the gig at the end of the last crisis. Wall Street came in, they bought up all that long-term rental, and everybody was like, hey, maybe I can get that passive income. And then you had fix and flip become just, the order of the day. And then COVID comes and we get the fiscal stimulus and, these low rates. And the Airbnb jocks are like, listen, the social contract has been broken. I can't, people, so I got fired. I'd worked there for 10 years, overnight. So people were like, how am I going to get passive income? Because I'm really sick of being taken advantage by my company. And everybody just went bananas buying all of that. So what's happening right now, because the census moves so slowly, is people are not aware of how much vacancy is out there, how much speculation actually exists. But if you take a look at the coast of San Diego and all these places, you can see they are just riddled, infested with short-term rentals. And so we are unaware of the speculation. And actually, the Philly Fed put out a paper last January that said, hey, guys, speculation didn't end after the GFC. And by the way, when investors are involved in the housing market, it's 30% more likely that there's going to be fraud. And so you have things like non-owner occupancy fraud. I've heard from veterans. I've heard from all kinds of people who have used their benefits, not legally, to get Airbnbs and rent them out. And so this bug was massive. And we don't understand. So Sevierville, Tennessee is just a tiny little town right down the street from me. They have over 8,000 Airbnbs there that you will never need that many Airbnbs. And so right now is the time, if you're smart and you go around and you can sniff and you know the tools, like you know how to look at county records, there's some services out there that'll tell you about delinquent tax liens, things like that. You might be able to find a deal, but it's going to take a lot of work. If you are just new thinking about investing in real estate, right now is the time to just sit and watch. And, perhaps, follow someone like me, because I look at it from every single angle, not aggregate. I track 80 cities. I track delinquency, credit quality profiles, employment, all of these things in these cities, because real estate is local in many respects, except for the financing, right? And so it is so what happened? Let's take somewhere like Raleigh, North Carolina, for instance. Apple announces they're going to they're going to do a brand new headquarters there. This is, during COVID fever dream time. Everybody goes bananas. I think Intel was there as well, somebody else. And so they just start going. I mean, they go around the perimeter to all these little sad little older towns. They buy everything up, and you drive around these, Jesse, and these towns are in complete disarray because they're flipping all these older homes. But then you have all the new build communities that are on that outer perimeter pulling people out as well. And so what happened? Apple's not coming. They're still saying, okay, we're delaying it, but this is like the third delay. They're not coming. And the other company I was talking about just announced as well, they're not getting their money from North Carolina because they were supposed to bring like 3,000 jobs. They brought like 400. So everybody just went wild with speculation on the commercial real estate side and on the residential. And those two are inextricably linked. And I think our commercial real estate problems everybody is aware of. The problem is they don't see the link between residential, and they don't understand, because we don't have updated stats, what the vacancy looks like out there. And we know we just built the largest amount of multifamily, and we don't have the demographics to support it, even with immigration. So right now, I would be just learning as much as I could about real estate and be ready for when those opportunities come.
I'd like to get both your thoughts on kind of the speculative mania that exists across a lot of markets right now, because we're seeing, crypto meme coins get pumped to really unreasonable levels. We're seeing, single day call options on companies, the highest level of participation, I think, in a very long time, and that sort of basically gambling day to day on the price of the stock. Is this sort of an environment that was created during COVID, when pandemic stimulus was put into so many people's hands who maybe normally wouldn't participate in the market? Do you think that's a big driver of that? And do you think it's going to take some sort of extremely big correction, in both the real estate market, perhaps the broad market as well, to wash out this kind of speculative fever? And Jack, I'll start with you.
100%, Jesse. This is absolutely a mania that's being driven by easy money. And, we have this mistaken narrative right now, and we've even heard it from Jerome Powell this week over and over again. He talked about how monetary policy was sufficiently restrictive and we want to dial back our restraint. They've been telling us monetary policy has been restrictive, but since October of last year, the money supply in the United States has been increasing. It's been increasing rather dramatically. And, monetary policy was sufficiently restrictive starting in 2022. And we saw it. The stock market was heading lower. We had the mass layoffs at the beginning of 2022 in big tech. And then all of a sudden, 2022, November comes along. We get this AI bubble starts. Private credit starts lending like crazy. We passed all these rules that say banks can't make risky loans unless they hold extra capital. And then we create this whole new cottage industry. We call it private credit, which are basically banks that aren't banks. And they're doing exactly what the banks aren't allowed to do. And they're doing it with money borrowed from the banks. So really, it's the bank's money anyway. They're doing exactly what they told us they weren't going to do anymore. And the money supply is growing. On top of that, you've got fiscal dominance over in Washington, where government spending is offsetting quantitative tightening by the Federal Reserve. And it's ultimately resulted in more money sloshing around in the system over the last year, significantly more. And in a shocking turn of events, you get things like Fart Coin and Hawk Tuah token that end up going to like billion-dollar valuations. People think this is different. This is new and unique. This is the same crap with a different smell that we've always seen during speculative manias. And there is no painless way out of things like this. Unfortunately, all these people who, like cab drivers, shine boys, who are now day traders, they need to be washed out. They need to get wiped out in order to stop that FOMO. I hate to see it, but it's probably going to happen again.
Yeah, very interesting thoughts. And when it comes to, I've spoken to several of my friends who had never really invested before, and now all of a sudden they're taking gambles and all these different things. I just say, oh, that's cool, and I change the topic, because there's really no convincing anybody in that position that what they're doing doesn't make any sense, and they should spend a tremendous amount of hours studying and understanding markets, which no one's willing to do. Melody, what are your thoughts on this issue of such a speculative mania that we're seeing these days?
Can I interest you two in some tulips? I mean, this is insane. I mean, I think I had to walk away from social media a little bit, because I couldn't believe it. I think this is exactly what happened during the GFC for housing. It's like everybody got a little hurt, right? A little hurt, but not hurt to the point of like destruction. And so what happened? It came back on steroids. And so I think exactly what Jack said, we were heading into a correction. And then we had the banks fail, and then we had the BTFP, or I like to call it buy the F and put. So like that's basically that turned everything around from a sentiment perspective, in my opinion. And when people are like, "Oh wait, I'm going to get backstop," oh well, let's just go. Let's go. And so. I also believe we're going to have to let the destruction fully play out this time. And I honestly believe we never let it play out from the GFC. We can't, that's why we still have all these huge, massive buildings that are empty out there. You can go to Dallas. They have all this empty commercial real estate. What did they do instead of like rehabbing a building or bulldozing it? Oh, I don't have time for that. I'm going to make much more money building this shiny skyscraper that, by the way, nobody's ever going to be in. I mean, you can see these in Austin. They're everywhere. We have so much bulldozing to do, like it's insanity. And a lot of that happened because we extended and pretended, at the end of the crisis, we never fully recovered, in my opinion.
And let's talk about commercial real estate for a moment, because you touched on it there. And we spoke maybe a little bit more with more of a focus on residential earlier when it came to the overall picture of the real estate market in the US. How do you see things from a commercial perspective? In that particular sector, are there any opportunities at the moment? Is this just kind of the same? You want to be sitting on the sidelines for now? Melody, I'll start with you on this one.
Oh, you will? Okay. Yeah. Everybody that's out there saying Class A is going to be fine. No. You got to look local. I mean, so Jesse, I don't know how many if you know this, but I've driven over 10,000 miles across the country looking at these markets. And I'll just give you an example. People like Class A. Okay, well, I was living in Pittsburgh, and it's called Cannonsburg, but it's a huge live, eat, play location where they had a nursery. They had all these about 12 Class A commercial real estate buildings. They had everything, golf course. They had the condos on the golf course. And, before COVID, they had a few good tenants. Well, guess what? They're all gone. That's all Class A, and it will never be inhabited again. The only way is if someone comes up with a creative solution, like doing a university there or something, or maybe creating a senior community, something. But no one's thinking like that right now. All they're thinking about is, how do I make quick money? They don't want to invest in they don't want to create solutions. They just want to make return. And so maybe there are opportunities out there, but I would caution anyone, especially from the sell side on this stuff, dig in and really look at that market, because I don't care if it's Class A luxury with, a pickleball table and arcade and all this kind of stuff. If you don't have the right industry there, that building will never be occupied. So But this is what happened during COVID is everybody got a brochure in the mail that said, buy your Class B multifamily and you're going to make millions. And they got on a bus and they went down to these cities and they picked their one and they did no other research. And I think that there are going to be smart players that make some good deals in commercial real estate, but it's only if you truly understand all of the dynamics of that market.
Very well said, Jack. Your thoughts on commercial real estate at present?
You know, I would like to just like kind of wander into Blackstone headquarters one day and just kind of stand in the corner and shout, "The floor is price discovery," and watch everybody jump up on their desk. watch Steve Schwartzman hugging this giant printer to avoid price discovery at all costs. Because the commercial real estate industry, like we know this stuff isn't worth what they say it's worth. And for whatever reason, how many years into the CRE crisis are we now? We'll say 2, and I think that's optimistic. It's been 20 years in the making. Mm-hmm. And still, these guys are carrying this stuff on their books as if it's still worth 2018 prices. We all know it's not, but they're still putting it on the books at that. I mean, are we going to talk about what the emperor is wearing or lack thereof? At some point, price discovery will catch up with them, and it's going to be a mess when it happens. I'm amazed how long they've been able to avoid it. It's really a testament to the froth and the greed and stupidity and just corruption in our financial system that they've been able to get away with it. Every time one of these buildings goes up for sale, it's almost always at an auction. It's almost always handing the keys back to the lenders, and it's for, in some cases, single-digit percentages of what these buildings sold for in 2015. And yet Blackstone, Starwood, all these outfits are like, we're doing great. Our portfolio is robust and strong. Well, maybe it's because they're able to pass off all these losses onto the pension funds and the retirement accounts that actually own the shares in these things, and they're somehow able to just walk away from the debt. Now, there was a really interesting story I just talked about in my morning live stream today. I'm not sure when this is going to air. But Big Lots just announced yesterday they're filing for bankruptcy. They're closing all 900 of their remaining stores, 27,000 people out of work. See also earlier comments about the labor market and affordability. But think about what that means from a commercial real estate perspective. A Big Lots store tends to be one of those big anchor locations at like a strip mall, right? Well, all the rental contracts at a place like that for all of the smaller stores in the strip mall typically have riders attached to them, where if an anchor location goes vacant, it triggers a big substantial drop in the rent for the remaining tenants. And just in this one story that hit the tape yesterday about Big Lots closing 900 stores, you're talking about 900 of these locations around the country where not only are they not going to be getting rent from Big Lots, but all the remaining locations at those strip malls will also see lower rents. So those owners and the people who own the debt backing those buildings are in big trouble. And that's just one anecdote of Big Lots. Now, rinse, repeat that across all of these other retail chains and other operators that are running into problems here. This commercial real estate bubble is still getting worse, despite daily calls from a bottom from the people on CNBC.
Well, Melody, you mentioned Canada earlier in the conversation. I'd like to touch on that as well. I live in Serbia, but I go back home and visit Canada every year. And what I've been noticing is the house prices climbing higher and higher to the point where now what $1 million can get you is really not all that impressive. And of course, that depends on jurisdiction. If you're willing to live kind of out in the wilderness, northern British Columbia, for example, maybe you can get something decent for $500,000. But if you want to be anywhere near a city, you're paying a very high price. What do you think has caused this? Many people are pointing to it. We've taken on too much immigration, and so they're projecting that out into the future, although apparently there's been some changes made to immigration policy and there'll be less people coming in. But people are saying, well, the house prices aren't really going to drop because we just have too much of a population entering the country for the amount of inventory that's available. Others would say, no, it's more of a real estate bubble that will pop eventually. I wonder what your thoughts are.
Yeah, so I'm not a specialist on Canada at all. I'm too busy tracking the U.S., but I would recommend people follow Ben Rabideau on Twitter. He is very well versed in this market. But and the Bank of Internet Settlements does a great, every quarter they do a deep dive into all of these issues, cross border collateral, things like that. But they focus on housing, and Canada has been on a watch list for some time, but they talk about how, what's happening locally really is important as to when that might happen. What I can say about Canada, just based on the little that I know, and it is very, very little, is that the cost to carry the underlying debt on this is getting to a point that is untenable, in my opinion. And, as they reset this I think you're about to see some real trouble. What the cause of it in Canada is, I can't say exactly. But I think what you just mentioned, if I started digging, I would be able to combat a lot of the narratives that you just said, because I think in the United States, a lot of the pushback I've gotten is on immigration. I don't care. I've seen the inventory. It's out there. I don't care how many people are coming in. You go to San Antonio, we could probably house Mexico at this point down there. So it is just insanity. And so I think in this mania that we've been, and I think we're a globally synchronized economy. And so I think we've all been in a state of mania for some time. And also in this state of, I need to get mine. I need to get mine. And however that is, buying a house, whatever it is. And so, the narratives to support that have been very, very strong. And so few people actually know what's really happening. And so I'd love to, Jesse, at some point have some time and go debunk them in Canada, because I guarantee you it's a lot of narrative, whatever it is, masking what's truly going on underneath.
Yeah, that makes a lot of sense. Jack, do you have any thoughts?
Yeah, I mean, on the immigration front, you're always going to have people with pre-existing political dispositions. It's a very emotionally charged topic, and you're going to have people who come in with pre-prepared remarks one way or another. So politically and emotionally, it's a minefield. Look, to uproot yourself and move to a different place where you don't even speak the language, a strange country, in hopes of a better life, my hat's off to anybody who would even try that. That's got to be scary as all get out. And not for nothing, the kind of people who are willing to do that are probably arguably the kind of people you want to have in your society. You get people who are willing to put the work in and do that. So now, that all that being said, when you bring people in, all right, if there's a roof over their head, they're adding to demand for housing. All right. So let's not act like immigration is not affecting the supply demand dynamics in housing. If they're here and they're living in a place, they are adding demand. But the other facet, I think, and I think what's more important towards housing bubble dynamics with immigration, is not so much the added demand as it is what they do on the supply side in the labor market. See earlier comments about affordability and how the average person is spending 38% of their take home on housing. Well, one of the reasons why the cost of inflation has outpaced wage gains is because of the influx of people, at least stateside. I don't know if it's as big a deal in Canada, but you can see it in the jobs reports in the United States. Millions of Americans have dropped out of the labor force, and millions of, the term used in the BLS reports is non-native born workers, which includes both legal and illegal immigrants. It also includes American citizens born in other countries, but the majority of that is going to be illegal immigration, right? So when you add mass amounts of labor supply and the demand stays the same, labor prices go down. So it's preventing wages for everybody else from rising, which is adding to the affordability problem that exists. So yeah, immigration, it doesn't just hurt on the demand side, it also hurts on the supply side in the labor market. So it squeezes the labor market at both ends. And I think it's causing problems, and it's adding to the cumulative hardship of inflation.
Well, let's step outside of the real estate market for a moment, because it doesn't look like there's a lot of opportunities there. Maybe in foreign jurisdictions, hey, here in Serbia, you can get a really nice house depending on where you're at for 160,000 euros with a big lot and everything like that. So maybe in some of these emerging economies, there might be some opportunities out there. But for the time being, when it comes to markets in general, where are you currently looking for opportunity outside of real estate? And Melody, I'll start with you.
Jack would probably be better at this, but honestly, I think that focus. So I'm going to say something that's going to be the opposite of what you're probably asking me, Jesse, but I'm just kind of passionate about it. Is like, firstly, there's no debt. Like, we are entering into a time that I think that we might see the play out of the GFC. We might be in such hard times, and so I would say make sure whatever you're doing, just pay off as much as as you can right now and be, because that's where it's going to hurt the most. We've seen those credit card rates, right? So if you were investing using leverage, I just don't think that is a really good idea. But so I'm going to say something else as well. Make sure that you have. I believe in lifelong learning. Make sure that your skills are up to date, because in a challenging economy, you're going to need to be able to pivot. So always be out there learning new things. The other thing I'll say is hard assets. Yes, land, your gold, things like that. However, that's tricky right now if you don't have that stuff already. So you're going to have to be careful. And then, of course, just getting the return you can, and sort of the money market accounts, while we still have rates at these levels. So I stepped out in 2022 from the markets. And honestly, I think right now it's tricky for long-term treasuries. I think, yeah, you'd still be okay in the short end, but I would say short end, 4 weeks, 8 weeks. I mean, you look at what just happened is all of a sudden we were talking about the Fed, and they came out and they did something nobody was expecting. But then front page the next day, Trump's talking about the debt ceiling. And I mean, and it's a lot of political drama. I'm not saying that anything's going to happen, but this stuff brings volatility. And so I personally would stay on the very, very short end in buying T-bills.
That's some great information there, because yes, investing in yourself is so important in times like these, and tightening the belt and making sure that you're living below your means and that you actually have some cash on the sidelines, like you're saying, maybe in short-term treasuries to get a little bit of a yield, which you still can get, around four and a bit percent at the moment. So I love that. Jack, your thoughts on where you're looking for opportunity right now in the markets?
It's kind of funny. I'm going to the same place Melody went, but I'm going to get there by a very different route. But destination is the same. Pretty much everybody in the financial system, right? They run the financial system. They're surprisingly young. They're 20s, 30s, right? And a lot of millennials, people who have never seen higher rates. Their entire life is based on lower interest rates. Just by rates are going down, they're going to print, they're going to lower. All right. We're watching governments collapse around the world right now because that doesn't work anymore. Germany, France, to a lesser extent, South Korea, right? The circus going on in Congress right now. There is pushback on this. Now, if you zoom way, way out on the charts, go all the way back to World War II. Post World War II, you had about a 40-year period of substantially higher interest rates. If you look at the U.S. 10-year yield, go all the way back to the end of World War II. Interest rates rose pretty much from the mid-40s all the way up until 1980, higher interest rates. That was a 40-year cycle of higher rates. Then, obviously, at the end of the Volcker era, we had the 40-year era of Zerpenberg, of lower rates and money printing. And that's the era that everybody in the financial system is basing all of their experience on, is that 40 years of substantially lower rates. Well, 2022 came along. The inflation post-COVID changed that. And in my opinion, we're in a new 40-year period of steadily higher rates, possibly for decades. And everybody, people are like in commercial real estate, oh, the lower rates are going to save the day. The Fed is going to save us. Well, have you seen what's happened to the 10-year yield since the Fed started lowering? It's done nothing but go up. All right. The Fed doesn't control the long end of the yield curve. Interest rates are going higher. So, yeah, you don't want to be in debt right now because debt's getting more expensive. And, there's one guy, one big name in finance who was around. Go back two of those big cycles to that post-World War II era. There's one guy that made a name for himself back in that day, Warren Buffett. All right. He came up in the 60s, right in the middle of that. And you know what Warren Buffett is sitting on right now? Last I checked, $325 billion of cash. He's selling tech. He's selling banks. He's selling everything, and he's buying nothing. And he's the only one out of all these big names in Wall Street and all these arrogant a-holes, in my opinion. He's the only one who's ever seen higher rates, and he's sitting in cash. So if you're sitting in cash, you might as well park it in T-bills and make a few percent while you're doing it. So, Melody, I get to the same place you did.
Very interesting insights from both of you. This has been a fantastic conversation. Greatly appreciate both of you coming on. Melody, tell us about the M3 Melody Substack, and anywhere else you want to direct people online, feel free.
Sure. So this is a Substack where I try to craft a narrative, Jesse. I do a lot of data, a lot, but the data, in my opinion, can become so overwhelming, right? If you don't have context of what's going on. So I rely on my experience of managing the last crisis, and I worked both in finance and in default operations during the crisis, as well as with our bankruptcy when that happened, as well as with the Fed on the consent orders when the mortgage industry got into trouble. So I bring that perspective to what I see now and things that people just don't even know to look for. Because if you don't understand the way that the whole system works, you're going to be surprised every single time. Like, the person that's surprised right now who is told, date the rate, you'll be fine. Date the rate. And how many people were told that? They're not going to be fine. So if you had been reading my Substack, you would have known that the Fed doesn't control mortgage rates. You would have understood that. You would have understood what to see signals. So I would recommend that. I'm also on X Twitter, M3_Melody, as well as on YouTube, more infrequently, M3 Melody YouTube.
Great. I'll put links to all of that in the description below. Jack, tell us about Nobody Special Finance. Anything else you do? I know you do spaces on X as well.
Yep. Nobody Special Finance is the name of my YouTube channel. I do a daily live stream every morning, 9 a.m. Eastern time, financial news, market snapshots. That live stream also goes out to X. I'm at JG_new on X, so you'll see my content there as well. I like to do market news, and also I have a big chip on my shoulder, and I cannot stomach liars, crooks, and thieves. So I also like to do investigative reporting on frauds and, just the people who are preying on average people who don't want to be speculators, they don't want to be gamblers, but they're forced into this crap by these people who are getting rich off of this endless inflation and endless money debasement. And so I like to dig into that and call those people out. And hopefully we'll have something to say about some of this more ridiculous stuff like Fartcoin that's going on in the market right now. I'm digging into that one and finding some rather amazing things. Let's just say it doesn't pass the sniff test, to put it mildly.
Pun intended.
Fantastic.
Pun intended.
Totally intended. Yeah, totally intended.
I will. I'll go ahead and put links to both your X account and Nobody Special Finance YouTube channel in the description below. It's been a pleasure having you both on, and thank you so much for sharing all your knowledge.
Thank you, Jesse, so much. Always a pleasure to talk to you, sir, and Melody, you as well. Thank you.
Yeah, thank you so much, Jesse, and thank you, Jack. It's great to see you as always.